Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Bulls make money, bears make money, pigs get slaughtered. Now, this is an old market saying referring to when you are too greedy, you're asking for trouble. Jacques, I think the little recordings we're doing here for the morning will be going on social media, various social media. I don't know if they're going to be saved on a spot on the website, but I am not 100% sure of that. So it's been a very nice rally that we've enjoyed for several days. A very nice rally. Lots of short-term signals were produced, creating really profitable bullish opportunities. If you've entered trades during a rally where you had previously had a correction, a retracement, and its rally, you have to ask yourself, what was my target? What was my objective in that trade? Was I getting in, hoping that a trade would go to the moon, clear up to resistance, clear up to the all-time highs? What was my target? One of the primary mistakes that new, intermediate, even experienced traders make is sometimes they get a little greedy. They get in profitable situations, but don't have a clear plan on how they will exit a profitable trade. Ironically, traders sometimes do better managing a losing trade than a profitable trade, especially during certain market conditions. Certain market conditions where you'll have a rally, you'll get into bullish trades, but there's not a realistic target based on the trade. Gino, some of the trades you've made this week, Noah, you as well, what were your targets on those bullish positions?
Okay. I don't know if those mic's going.
No, I can't hear you.
My targets were retracing back to a resistance or the 20-day moving average, but also I don't know if it'll make it there. So what I've been doing is just moving my stop up below the low for the previous day. And that way the market will take me out when it does do a swing high, because I don't know if it'll make it to the target.
Gino, will you give me one example of a trade, and we'll pull up chart and do that.
I want to say maybe dig
and I'll walk through what you're talking about. You got a specific.
Well, Netflix is a good one. Netflix is a good one because it's on the stock report. Netflix, the target on this is really high. I mean, we're talking 286.81 is the last resistance. I mean, that'd be wonderful. It got up another 15, 16 points from where it is today. That'd be great. I mean, because it came all the way down to the trigger point, which was 258 or something like that. I mean, that would be a phenomenal run. That'd be over 10%. But I don't know if it's going to make it up there. I didn't even know if it'd make it over that minor pivot that you see right there at 270.5. The 270.5 pivot is what's hitting today. That's what it's having resistance with today. So will it stair step up all the way to your target? Yeah, that's what I'm worried about. That's what it's hitting today. Will it stair step up to your target? I don't know. So my stop loss was way below the pivot. Then it goes up to the 20-day moving average. then it takes below the previous day's low. Once you lock in profit, you can start moving your stop below the previous day's low. And like right now, I'm even considering, instead of yesterday's low at 258-ish or whatever, moving it up to today's low already. I mean, usually you wait till the end of the day as a swing trader, but why? If you think this is going to turn on you, and it can, you might want to get out, you know. That's one of those things. Maybe I'll put half the position there. Another one, Mark, I would like to look at is retracement play. Retracement play would be AT&T. Just T, yeah. You know, this is oversold. I don't mind owning AT&T. I don't mind doing covered calls on it. So if I don't mind owning it, even in a downtrend, I'll play the swing because honestly, this is a dividend play anyway, and a covered call. So right now, it's not really rallying up as nice as I thought it would. You know, I thought it would keep going. But look at how the white candles the last 5 days stair-stepped up and kind of stalling and hitting that moving average. It's hitting its 10-day moving average. Is that what you got, the 10 or 9? What do you got on there? Yeah, that looks like 9.
I have the
They
9.
can't get above that. That kind of scares me. So it's like, okay, if you can't make it above your 9 when a lot of the other stocks are, what's going on? That's very bearish. I mean, I wanted to get up to the next moving average, which I think you either have the 50 or the 20. Was that 50? Yeah, 20. Okay. So that's the one I would like it to get up to. So, you know, looking at this action here, I might just get out. I might be like, you know what? This is like one of those fireworks. You light the fuse and you're like, dud. So it's not really coming out of the gate as the market's rallying. So if I'm playing against the trend, you got to be quick on the draw, because if this thing breaks on a swing, it's going to drop quick again because it's already in a downtrend, you know. So moving the stop up in a volatile market is a little bit quicker than normal. I take advantage of it because in a volatile market, you got to move faster because the market's moving faster. If it's moving twice as fast as normal, you got to work twice as fast. So that's what I do with my stops there. Now, there's other things you can do by buying puts and stuff, but I don't want to get too advanced on that. Noah's got a good take on it.
Yeah, I'd shorten my expectations time frame wise. Whenever I'm in a more volatile market condition, I have a real habit of wanting to take the money and run. Just because conditions, you know, if I expect normal swings to last 2 weeks, in a volatile market, I expect them to last maybe 3 to 5 days. You know, you get those, you know, whipsaws in the market during these volatile times, and I think the best way to control the risk is to just, as a trader, use tight stops, adjust the stops to lock in your gains, and just, you know, we're not looking at a regular bull rally here. We're looking at a you know, recovery from a very hard drop. And one of the things we've talked about is that there, you know, the volatility pattern after the market correction like this usually takes about 6 or 8 weeks, somewhere in that neighborhood, you know, 4 to 8 weeks, for the volatility to shake back out. And that, you know, my solution's always been shorten my time frame as a trader.
No, and that is something that I've been hearing and reading over the last 48 hours. And it's one of the reasons we brought up this subject. Now, nobody knows the future.
Well, I'll make
nobody
a very
pretends
bold
to know
prediction,
the future.
Mark.
But what you
Today, the market's going to close.
Yes.
It's going to close. Yep.
This market's going to close, and that's about.
And I'm pretty
bold
sure that today
prediction
turns
that you
into
can make
tomorrow,
for
and
the
tomorrow's
future.
Friday, and the market will close on Friday too. Those are my bold predictions.
Well, and bold prediction they are. But what I've been reading everywhere is, and once again, people have their opinions, but it seems like the wide consensus amongst traders right now is they don't trust, and I'm talking about experienced traders, people that I listen to. Nobody trusts that this is just going to be a permanent V-shaped recovery. And what a V-shaped recovery is you have this down and then you have a big move up. And by the time it gets to the up, it looks like the letter V. So you have a big move down and a big move up, recovering it all immediately. Most individuals out there, and once again, take it for what it's worth, expect the market to maybe get there eventually. And as Noah said, a lot of people that I'm reading is, normally if you look back at history, which is really the only gauge we have, when you see these type of corrections in a bullish market, because we are still in a bullish market, when you look at the trend over the last year, the volatility aside from the last 10 days, it's been a really strong bullish market. But I can't find a single person who's predicting a V-shaped recovery where we just go immediately back to the tops.
Well,
because that's historically.
Yeah, Mark, I was just going to say, go back and look at the market from the time, from the crash of 2008 and watch the entire run up. There's, half a dozen corrections in there, but only one of them is a V-shaped recovery. The rest of them are double bottom type recoveries. If you go back and look, they take a little while to shake out. The volatility comes back in, and you just look at them, and there's just one quick recovery just before 2015. The rest have either not really that dramatic of a drop, but every other dramatic drop, it's a 6 to 8 week process for it to shake out. Even that one's a couple weeks there. You're on a weekly.
These are weekly candles.
Yeah,
that's
5 weeks,
candles.
right? Yeah, 5 weeks right there for it to form a double bottom. Go back I think the one right before that one's the only one that's really I saw that's a V-shaped. One more to the left, right? Oh, back between 14 and 15, 2014 and 15. There's one quick V-shaped recovery after a sharp drop right there. But the rest of them take 6 to 8 weeks. So
it's not that V-shaped recoveries can't happen.
Just
where you have the sudden drop.
Likely.
And then the sudden move up. It's not that they can't happen. It's that oftentimes you'll see a period where that support forms and then people believe in it. They're like, all right, that is the bottom for right now. When you go to where we are right now, nobody has that trust. And that's where you hear all of this opinion consensus right now on the market. Nobody has the trust that, well, that's the bottom and we're just going to V-shape. Now, you could, once again, V-shapes do happen occasionally. They are the exception rather than the rule. And so what we're asking, if you have open positions, what's your game plan? What are your signals to get out? What are your signals to stay in? Where will you take profit on bullish positions you've entered into this rally? It is something to certainly think about, something that I would spend a few moments on today. If you do not have that concrete plan. Remember,
here's another take on this, Mark.
Go ahead. Yeah, absolutely.
So yeah, just looking at it from like a trader's perspective, and Gino, I want you to chime in on this too. I know that you've been an active day trader at times, just like I have. There was a couple of years where I was probably an overactive day trader. And if I had a good week, if I started out with a trade on Monday, Tuesday, and I caught a market rally bet like this, by Thursday, Friday, my primary concern as a short-term trader is locking in those gains. And so just by default, I think heading into a weekend where you have some uncertainty with what happens, a lot of times those, over the weekend, you'll see as the Asian markets go open and whatnot, sometimes the big corrections happen on the Monday. And so traders look to exit by Friday. And so what's been running up, Monday, Tuesday, Wednesday, Thursday, if you're not shifting your perspective right here in this kind of volatile market and thinking, I got to get out, That's just what traders do. It's kind of like the psychology of it. Like by Friday, they want to close their trade so they can have a good weekend, go spend some of the money they just made and not stress about what the market's going to do. And they like to be flat at the end. So, most day traders want to be flat at the end of the day, but even when they catch a good move up, they want to be flat for sure by the end of the week. Meaning flat, meaning they're out of their position. So if they bought, that means they're selling, which it becomes a bit of a self-fulfilling prophecy.